All right, this is Bob Iaccino from Path Trading Partners. Welcome to Trading Out of the Money Nadex Binaries. Thanks again for being here. Thanks to Nadex for having us. I want to get started by quickly reading a risk statement. It may not seem quick, but it feels quick to me. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. Of course, we have limited risk at Nadex. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. So why did I quickly bring up that we have limited risk at Nadex? Because that is one of the reasons you're here, one of the reasons you should be here, is because of the limited risk profile of the binaries and the spreads. But remember, if you put $1,000 in your account and you trade a number of contracts that puts $1,000 at risk, you've taken maximum risk. You haven't limited it. So that's what the last couple of lines mean here. You should carefully consider whether such trading is suitable for you in light of your financial conditions. You can open an account of any size if you can control your per trade risk. Remember, part of the reason you're here is to help control your risk and help learn to control your risk. So keep that in mind as we go through this presentation or as you watch any of the presentations from any of the educators that participate in this program with Nadex. So who is Path Trading Partners? Well, we are a trading and education firm. Our mission was to form a trading firm that educates, supports, and backs traders. That's right, we provide seed money for traders in certain situations who are committed to probabilities, discipline, and long-term trading success. This is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. We are a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. We let the markets tell us what to do. We have our strategies, we have our process, we have our method, we have our discipline. But the market has to go along with it, otherwise we don't trade. That's basically what that last line means. Mike Arnold, top right corner there, is a 24-plus year market veteran who has been teaching traders online and in person for over 10 years. Mike was and still is a strategy and development consultant to multiple hedge funds. I mention all the time that Mike is essentially a professional devil's advocate. He has hedge funds that he's worked with that when they develop a new trading method, they send it to him to break it. They send it to him basically to tell them what's wrong with it. He's a former options market maker on multiple exchanges, and he has traded in Chicago, New York, Switzerland, and Canada. You didn't know he was a Canuck, did you? He is the current head of technology and trading systems development for Path Trading Partners. I am in the top right corner there with the pink shirt. Pink's kind of my thing. I've spent the last 24 years in the commodities, futures, and forex markets, and I've been teaching and mentoring traders both live and online since about 2002. I've taught and mentored over 5,000 students to date. My experience has been as an analyst, a proprietary trader, and a fund of hedge funds principal, as well as being a member of the investment committee in that fund of hedge funds, and that's where I think I bring value to the everyday trader because I've analyzed hundreds, maybe thousands of trading manager performance. And my specialty really is seeing how they react during losing streaks and judging that. That's something that I've done for years. So that's where I bring value to you guys, in my opinion. I've appeared on CNBC, CNBC Asia. I've appeared basically on every one of the business news channels and some of the regular news channels talking about markets, both of the political spectrum, economic, etc. And I continue to appear. It's about 5 times per month now. Sometimes it reaches 10. Next time I'll be on CNBC at the lunchtime hour at their halftime report. I believe it's on Wednesday. I think that's the next time I'll be on, the 21st, whenever that is. I think that's Wednesday. To date, I've done over 700 interviews on various economic, political, and market-based topics. So, in a prior class, we covered the concept of moneyness and classifying a Nadex binary option as either out of the money, at the money, or in the money. We taught the Greeks what they are, how they apply to Nadex binary options, and how they can help the binary option trader understand price movement of the options and price changes due to Theta and Vega. If you need to learn these concepts, please watch the recordings of our prior Nadex binary classes after this webinar. After learning the Greeks, most traders wonder how they can effectively translate that knowledge and information into useful and actionable trading information. And this is precisely what we're going to do in this class when we look to trade Nadex binaries that are out of the money. However, first we're going to do a very brief review to ensure everyone is on the same page. I'm not sure if this link is accurate anymore, so I'm going to actually just show you guys how to find the archives, kind of show you where they're at. You just simply go to nadex.com, right, which I'll put up on the screen now. All right, there you go. Right there. All right, so here's nadex.com. You go to the Learning Center, you go to Webinar Archives, and then you can filter by Path Trading Partners right here, and you'll see all of our webinars, and you can see Theta Capture right there, 10 Rules of Trading, building your trading plan, understanding Nadex price theory, breaking down Nadex spreads, and we have a whole series of webinars in these archives about the Greeks. It's the introduction to the Greeks and Nadex binary options. So these are the ones that you want to look at to kind of get on the same page if you haven't seen them already. But in the meantime, let's do that quick review. Binary options are worth either $100 or $0 per contract upon expiration. If the Nadex settlement index is above the strike price of the binary option, then it is worth 100. However, if the Nadex settlement index is equal to or below the strike price of the binary option, then it's worth 0. Now let's talk about out of the money versus in the money. We refer to a binary option being out of the money if it's trading below its strike price. We refer to a binary option being in the money if it's trading above its strike price. This is very important to get just those 2 points. If a binary option is at the a binary option is at the money if it is trading right at the strike price. This is regardless of whether you're looking at it long or short. Okay? Now, for the purpose of this course, we are considering at the money binary options out of the money, since they are worth 0 if the Nadex settlement index settles right at the money. Now, this is a little bit different than traditional options. Okay? So, but for the purposes of this course, if it is at the money, and it's out of the money, because at settlement, at expiration of the option, it's worthless if it's exactly at the underlying strike price, if the strike is exactly at the underlying price. So keep that in mind. So binary price versus the underlying. Again, this is considered out of the money. What you're looking at here is a theoretical 2010 strike binary option. So greater than 2010 is what it would look like on your ladder. All right? If it is exactly at 2010, it is at the money. Okay? And anything below that is out of the money, and anything above that is in the money. Remember, the strike reads as 2010 greater than, right? Greater than 2010. So above 2010, you get paid. Below it, you don't. At the money, you don't as well. Keep that in mind as we go along. Now, quickly, intrinsic versus extrinsic value. Now, let's examine the intrinsic and extrinsic value of a binary option. Intrinsic value as defined as the in-the-money portion of the option value, or the value that the option would be worth on expiration. Extrinsic value is defined as the worth assigned by external factors, such as time and implied volatility. Intrinsic and extrinsic value are very interesting when examining binary options. Unlike spreads, where the intrinsic value increases slowly after the underlying passes the at-the-money strike price, binary options increase in a digital fashion upon crossing the at-the-money strike price boundary. For example, when the price of the underlying passes the Nadex binary option at the money strike price, the intrinsic value goes from 0 to 100 instantly. Think about that. Anything above 2010 in that example I showed you at expiration is worth $100. Okay? So 2010.1111, whatever it is, anything above 2010 makes the option worth $100. So the intrinsic value instantly goes from 0 to 100. But the price you see on the screen doesn't, right? When a Nadex binary option is trading at or below the strike price, meaning at the money or out of the money, then all the value is extrinsic value. When a Nadex binary option is trading in the money, then the value is a combination of extrinsic and intrinsic value, right? Because below it has no intrinsic value. Remember, intrinsic is what it would be worth if it's expired this very second, okay? So if you're out of the money, it would be 0. So there's no intrinsic value. All of it's extrinsic. But when it's trading in the money, the value is a combination of the two, right? Well, what is interesting to note is that when the binary option is in the money, the extrinsic value is negative, which is why the trading value is less than $100 before expiration. So this is a lot of information, and we're going to say this at the end, but you're probably going to have to watch this over and over again, but think about it. The second that the 2010 binary option goes to 2011, it's worth $100. At 2012, it's worth $100. At 2013, it's worth $100 at expiration. But prior to expiration, when you look at your ladder, it's not worth $100. Why is that? Because the extrinsic value is negative. So what makes up Nadex binary premium? Well, it's intrinsic value plus extrinsic value, as we mentioned. And extrinsic value is time value and implied volatility. Now, quick coverage of the Greeks. We can apply these Greeks to Nadex binary options. The definition of each Greek is as follows, and this will all go into when Mike begins to speak soon. Delta is the sensitivity of the binary option price of the option you see on your ladder, to price changes of the underlying. Gamma is the sensitivity of the delta to the price change of the underlying. So how quickly will the delta change as the underlying price changes? Theta is the sensitivity of the binary option price to the passage of time. So where gamma applies to the price change in delta, or value change in delta, I should say, theta applies to the binary option price, with the passage of time being its component. Vega is the sensitivity of the binary option price to changes in the implied volatility of the underlying, okay? And then rho is the sensitivity of the binary option price change to changes in interest rate. We're not going to be covering rho much, okay? So the extrinsic value components are time until the spread expires and volatility of the underlying. Again, because rho is changes in interest rate, we're not going to be talking about this because 99% of the time you're going to be out of these things before an interest rate can change on you, at least in any meaningful way, right? Now let me turn this over to Mike, and he'll continue with the lesson.
Thank you, Bob. Very good introduction.
Very good interruption.
Interruption. You interrupted my train of thought. All right. See if I have this. Now we get into the exciting stuff. Not that your stuff wasn't exciting, but this session, guys, what are we going to be covering? We're going to be examining in depth how time, which is theta, as Bob just went over, volatility, which is vega, implied volatility, market direction, and momentum affect Nadex binary options when trading them out of the money. Up to at the money. Remember, at the money, if it expires exactly at the money, it expires worthless. So we're lumping that in with the out of the money category. This session will only focus on trading them, the options that are out of the money. Another session will focus on them when they're trading in the money. Since the intrinsic value of an out-of-the-money option and an at-the-money option are both 0, we're combining them, as I just said. And I really want to get that through because at the money, if it ends up exactly at the money, it's still worthless. Some people do not realize that. You guys now do. We will also be mainly focused on trading the binary options from the long side when reviewing our Greeks for the point of simplicity. But everything we're covering here applies to the short side. You just have to flip it around. So many traders look to trade the binary options when they are out of the money because they look at the reward to risk ratio and see they can get a larger reward than the risk taken. For example, they can risk 20, and if it ends up in the money, they can make the 100, so they're essentially risking 20 to make 80. This is especially true for binary options that are really far out of the money. For example, maybe you can put them on for, $5 or $8. Well, hey, I can buy something for $5 and make the 100. That seems like a really good reward to risk ratio. And it is technically a good reward to risk ratio, but it has to be in the right conditions. Because if you keep putting on these trades, even for $5 or $10, and they keep expiring worthless, you're still losing money. And you might not be putting them on in the right market conditions. You have to understand how they move. So in order to have a chance of trading the binary options successfully, the trader needs to understand the market conditions that are best suited to initiate these kinds of trades. Just trading a binary option because it looks like you can make a lot of money without a lot of risk is not a sound strategy. Once you understand the market conditions that you will be beneficial to putting on an out-of-the-money binary option, you'll be one step closer to becoming a complete binary option trader. You'll also need to consider this because there are many times you might want to not hold the binary option to expiration, but you still want to generate some money. You can get in this, not hold it to expiration, and if the market goes your way, the option will increase in price given the right conditions. However, traders have come to us and said, I put on this option, I bought it for $5, and the market moved a few points in my direction, and I could only turn around and sell it, an hour later for still $5, even though the market went in my direction, because other conditions affected that. So, and it doesn't, when it's that far out of the money, which we'll get into, it doesn't generate a lot of delta. So you have to understand that. So even though the market's moving, your option and price is not moving that much. That's one of the things we're going to be getting into in the next few slides. Here's a graph that we'll be using repeatedly. So this shows a long binary out of the money option. This is the out of the money section. It's got a 2010 strike, so anything highlighted in this light color is out of the money, including right up to at the money. This is a curve of the theoretical value with, let's say, 15 minutes to go. So if you were going to put it on and the underlying was trading at 2008, you could roughly put it on for maybe $20. If it was trading at 2009, you could put it on for roughly $30. Trading 2010, which would be right at the money, it's looks like it's maybe $45. If you went into the money, let's say 2013, you're roughly paying $80. Now you're going to be paying a spread. The bid and the ask, or the bid and the offer price, are going to be on either side of this theoretical value. This theoretical value also takes into account, as I said, a timed expiration, because all these option pricing models have a timed expiration, as Bob covered. It also takes into account a specific implied volatility. The two factors that will change along with the underlying price will be the implied volatility and time. Time is constantly changing. So, intrinsic or extrinsic value. When trading in Nadex binary options that are out of the money, there is not any intrinsic value. All the value is extrinsic value. Since all the value is extrinsic value, time is working against the trader from the moment they establish a position. Go back to this graph real quick. As Bob talked about earlier, the moment it passes 2010, so let's call it 2010.1, being right on the other side of this line, intrinsically it's now worth 100. You're not going to trade it at 100. You're not going to get 100 because there's still timed expiration, and the extrinsic value, which is what I'm talking about now, is negative. On this side, in this orange box, wherever it is in this orange box, intrinsically it is worth 0. It has not passed that boundary yet to where it's intrinsically worth the 100. So any value you're paying for anywhere into this box, up to and including right at the money, you are paying for all extrinsic value. So anywhere on this curve, trading on either the bid or the offer, it's all based off extrinsic value only. It's theoretically, because when you get to expiration, if the underline's anywhere and you're in this box, it's going to expire worthless. So, if price action is stagnant and not moving further towards and through the strike price, through the at-the-money price, then every minute that passes hurts the out-of-the-money binary trader. This is especially true as the binary option gets closer and closer to expiration. This is your time decay. This is your theta decay of the binary option. So, theta can help or hurt the binary option trader depending on if the binary is in the money or out of the money. However, if the underlying price remains out of the money, then time is working against the trader. When you're in the money, time is actually working for you, and we'll cover that in a future lesson. Therefore, theta is decreasing the extrinsic value every minute that passes. As the binary option approaches the expiration time, the time decay increases rapidly. Another thing you'll want to take away. If there's 2 hours or 1 hour until expiration, you still have time decay, but it's not as rapid. You're not going to notice it as much as with 5 minutes or 10 minutes to expiration. Here's a model of that same binary option, price versus time. Okay? So, again, here's the underlying price, and we're looking at it in this highlighted box. With 60 minutes to go, let's say you're trading it with the underlying at 2008. If you put on this, if you were to purchase this out of the money binary option, you'd be roughly spending maybe just under $40. Let's call it $38. All right? Oops. If you were to put that same option on with 30 minutes to go, it would maybe cost you closer to $30. Well, and we're assuming in this graph that implied volatility is not changing. Let's just say implied volatility in this graph is 20% and it doesn't change throughout this whole period. So the only thing that's changing, underlying staying at 2008, the only thing we've changing is time. So as time gets closer and closer to expiration, that's what's changing the price. So you see as it goes, it's still at 2008, market hasn't moved, it's gone from 38 to 30. With 15 minutes to go, maybe it's now only worth 22. With 5 minutes to go, it's worth maybe 10. With 1 minute to go, it's maybe worth $1. What changed? The only thing that changed was time. This is an example of time decay. The passage of time, since this was only extrinsic value, it ate away at that extrinsic value. That is what's called time decay of an option. So you see, wherever you are out of the money, this time decay is going to affect it. It might not affect it the same. For example, if it's trading about 209.5, you can still see some time decay, but between 60 minutes when it looks like it's trading about just under 50, let's call it 48, to 30 minutes, it might be trading 46, to 15 minutes, it might be trading 43 or 44. Even with 5 minutes, it still might be trading 40. So the time decay didn't affect it that much up here because it was closer to at the money. Whereas down here, maybe 2006, with 60 minutes ago, you're paying 22. 30 minutes ago, it might be worth 17. 15 minutes ago, it's already dropped down to maybe $5. 5 minutes ago, it's virtually worthless. Why? Because we're farther out of the money and there's very little time for it to make up this ground and get into the money. This following graph shows this is your time decay. So anywhere in this graph, you see these values are negative. So every minute that passes, okay, this is eating away. When we get to the in the money in a future lesson, you can see how it goes to positive. That's where we can say time passage can help the trader if they put on a binary option when it's already in the money, or once their option goes in the money, time passage actually helps you. It increases the value. When we're still out of the money or at the money, time passage hurts you. Now, here's what happens to that theta or that time decay as time passes. So we're here at 2008. See, at 60 minutes to go, this light blue line, it's slightly negative, but not very negative. So every minute that's passing is just affecting you a little. You get to 30 minutes, it's affecting you a little more. 15 minutes is affecting you more. 5 minutes, it really starts to affect you. All right? 1 minute, it's affecting you even more. Look at it at 2009. So this is, 1 point below at the money. Right here, remember these couple graphs ago? This one, see, 2009, it doesn't change much. It still decays, but it doesn't decay as fast as down here. Well, that's because it doesn't change as much, but it does once it starts getting closer and closer. 15, 5. Look at with 1 minute to go. If you're still at 2009, this is virtually losing all its value in the final minute. Why? Because it did not get to even at the money. And you can see how the opposite is true for in the money. This time actually starts helping you more and more as it gets closer and closer to expiration. So let's take what we just learned and sort of think about it as it applies to market conditions. So it's best to trade out of the money binaries during busy market conditions. Out of the money binaries should not be put on in quiet or stagnant market conditions, especially close to expiration. Why is that? We saw close to expiration, your time decay really kicks in. That theta starts eating away at that extrinsic value. So if it's quiet conditions and the market's not really moving, all that money you've spent is going to disappear as it gets closer and closer to expiration. If the trader expects market conditions to get busy and is trading a binary option with significant timed expiration, then it's okay to establish it during quieter conditions. For example, let's say you put this on with 90 minutes to go right before the opening of the S&P 500, the morning session when the stock market opens. And okay, when that time passes, 9:30 Eastern time, we generally get to some busier conditions. So if you're putting that on and you still have a lot of time to expiration, that's fine, because remember, with a lot of time to expiration, you're still losing a little time decay, but you're not losing that much because you're up here. You're really close to that zero line. So that's what we mean by that. For example, putting on the US 500 binary option expiring at 11 being put on between 9 and 9:30, since the cash equity markets open at 9:30 a.m., which creates a busier market condition. So that is fine, but to put on something that's going to expire, right before the cash equity markets open, because, and when it really goes stagnant, if it's not trading, you've just spent your money on essentially time decay, and it's not really probably going to go anywhere. So all that essentially theta is evaporating. All that time value is evaporating. Busy market conditions can lead to a couple things. First, it can lead to trending market conditions, which are required by out-of-the-money binary traders. You need to go with a trend. You need it to get further and further. First, you have to get it to at the money. Then you want it to go into the money. Second, it can lead to stable or increasing implied volatility, which is also very beneficial to out-of-the-money binary traders, which is the Vega component. And we'll look at how implied volatility affects the price of these also. The trader does not want price action to remain far out of the money for an extended period of time or move and remain at the money when the binary is close to expiration. All out-of-the-money binary options would need to have a trending market which will take them in the money. The further away from the strike price the option is trading, the stronger the trend should be. So remember I said, hey, if you're going to put one of these on and you're spending 5 to make that 100, you better be having strong trending market conditions where you have a likelihood to get it further at either to close to at the money or in the money, especially if you're planning on holding it to expiration. You need it to go in the money, else that $5 will evaporate. So let's take a look at the binary options in Vega. An increase in underlying volatility or which is the pure underlying volatility, can lead to an increase in the implied volatility of the binary option. Also, if the market maker thinks volatility could raise, they can raise the implied volatility of the option model, therefore affecting the price of the option. This is beneficial to the out-of-the-money binary option trader if the price action remains a certain distance out of the money. The out-of-the-money binary option trader does not want the implied volatility to decrease because it decreases the extrinsic value of the binary option. As time approaches expiration, the effects of implied volatility shifts closer to the strike price of the binary option. Every 1% increase in implied volatility increases the price of the out-of-the-money binary option. Let me show you this graphically. Conversely, every 1% decrease in implied volatility decreases the price of the binary option. It's much easier to see on a graph. So, remember when we looked at the theta graph, theta was negative. Remember the theta curve was the flip of this. It was down negative, then it went positive over here. You notice the vega curve is positive. See, these numbers are positive? So if you're up to including at the money, this curve is positive. That means an increase in implied volatility helps you. However, a decrease hurts you. The opposite is true for in the money, which we'll cover in a future lesson. Let's look at how it affects the price. So now we're holding time constant. Let's pretend time is staying the same. The only thing we're changing is the implied volatility of the option model. So if you were looking at this at 2009, which is out of the money, because remember 2010 is at the money, 2009. If the implied volatility is only 5% in the option model, this option would be worth maybe $5. If all of a sudden time stayed the same and the market makers increased the implied volatility to 10% of the option model, the price would jump to $20. If they raised it to 20%, the price would jump to maybe $37. They can go to 30%, it would jump to $40. They go to 40%, it would jump to maybe $42. That's the only thing that's changing. So if you were to buy this, let's even take it more drastic. You were to buy it like in 2007, where it's with this time to remain, maybe this only has 15 minutes to remain, but you bought it here, and implied volatility went from 5% or 10%, where you're virtually, you're paying somewhere very cheap price, maybe $5 or under, and all of a sudden volatility goes to 40%, that option price goes from maybe $2 or $3 to $30 with just that one change. You can see how increasing implied volatility conditions can help you. Here's what the curve of vega looks. So now these are all your vega values, and this is how they change with time to expiration. So you can see how as time to expiration approaches 1 minute, look how these curves get closer and closer to at the money. Why? Because you need to be closer to at the money for any volatility changes with very little time left. Because there's so little time left, that implied volatility has to go really high to really affect your spread, because otherwise it'll still expire worthless. So you can see, with 60 minutes out, it's really benefiting the farther out of the money trader. As it gets to 30 minutes, you have to get a little closer to at the money. 15 minutes, you have to get a little closer to at the money to get the full benefit. 5 minutes, you have to get closer to at the money. 1 minute, you have to be really close to at the money, else it's not going to hurt you. I mean, it's not going to help you that much. Reverse is true for in the money. Now let's take a look at delta. It is important that the trader understands the delta of trading an out-of-the-money binary option. The delta is the amount the binary option price will move in relationship to a 1 point move of the underlying. So if the delta is 0.2, then the binary option will increase or decrease 1/5 as much as the price of the underlying. Remember I said that I've talked to traders and they bought something very far out of the money, and the price has moved closer to at the money, but their option price isn't changing that much. So they're looking at it saying, I bought this for 5 and now it's worth 6 or 7. That's because they had very little delta. So they might have had a delta of 0.05, which means it's moving 1/20th as much as the price of the underlying. How does this delta change versus time? So the delta of a binary option varies greatly depending on its time till expiration and the distance the option is from the strike price. The farther from the strike price, the lower the delta. When the binary option gets closer to the strike price, the delta increases, and the strike price again is the at-the-money price. This is especially true when the binary option is close to at-the-money and the expiration time approaches, it's close to expiring. Here's how a graph of the delta looks. This is really important for you to understand, and if you don't grasp it right now, review this a couple times. Remember I said far out of the money. Look at your deltas. So if you're putting on your binary option when the underlying is trading 2004 and it's a 2010 strike price, it's not generating. It's generating maybe a 5% delta, so it's moving 1/20th the amount of the underlying, the option price. So the underlying really has to move before you're really getting a lot of movement in your option price. Whereas you get closer and closer to at the money, especially closer and closer to expiration, look as it gets closer and closer to expiration. So if it's trading 2009, now every 1 point with 15 minutes to go, every 1 point move is generating you maybe $15, okay, because it would be 0.15 here. With 5 minutes to go, it could be generating you $20 for every 1 point move in the underlying. And you can see as it gets closer and closer, right at the money, as it gets really close, why is this delta so high? Because this is the tipping point to being whether it's worth full value or nothing. So as time especially gets close to, I know there's a lockout period where you can't actually trade them with the little final remaining sections to go, but this is how the model looks. Because why? If the underlying is trading either side of this, essentially when it's right below 2010 or at 2010, it's going to expire worthless. But one tick, or if it gets to 2010.1, with even a second to go, it essentially goes from being 0 to being 100. That's why your delta gets so high right at the money. But it's important to understand this. When you're very far out of the money, you're not generating a lot of deltas. So your option price is not moving that much in conjunction with the underlying. This is especially true if you're thinking of exiting it early. You're better if you're looking to exit something early, put it on closer to an at-the-money strike price, in this area, because you'll be getting a lot more delta. So as the underlying's moving in your direction, even if you're not through at the money yet, your option price is still increasing in value on a more rapid nature. So for some reason you want to get out of the trade early, you can probably still get out for a profit if your timing is right. Exiting out of the money binaries before expiration. So sometimes it is necessary to exit a binary option trade prior to expiration. At Path Trading, we do it all the time. One of the challenges with trading out of the money binary options that are not close to the strike price is there's very little delta. This means as the underlying rallies towards the strike price, the binary option will not increase in price very much unless the option is getting very close to at the money. Therefore, if the trader must exit the option early and the option price is not close to the strike price, the trader may not see the binary option price increase substantially. We've looked at some optimal conditions. Let's just flip it on its head and look at some non-optimal conditions. So we are not looking to trade out of the money binary options in quiet market conditions with very little movement. Why? Because you're just going to have that theta decay, and also if there's very little movement and there's no big news reports coming out and the options market makers don't think implied volatility is going to be increasing, it could be decreasing. And we've already looked how implied volatility going down hurts the out of the money binary option trader also. So now you don't have price moving, you have implied volatility going down, which is hurting your price even more, and you have time decay working against you. That is a very deadly combination for an out-of-the-money binary option trader. We are not going to enter into these options that are far away from the strike price, especially with very little time left. Why? Because you have very little delta. So even if your underlying starts moving, unless that underlying gets above the at-the-money price, your option will expire worthless. And the closer and closer you get to expiration, the more that theta is kicking in to deteriorate the option price. You're losing that extrinsic value in a more and more rapid fashion. Significantly decreasing volatility combined with stagnant market conditions drastically hurts the out-of-the-money binary trader, especially close to expiration. So what are some examples? Early evening trades in currencies, and usually in equity indices and commodities. Why? They're very stagnant conditions. There's not a lot of news generally coming out. Sometimes there might be. Sometimes there might be something going on overseas. Many times there's not. So these things aren't moving much, and they're not expected to move much. A long time before a major report release. For example, putting on an out-of-the-money binary option at 12 p.m. that expires at 2 p.m. when there's a major Fed announcement that is expected at 2 p.m. Why? Because price is going to go stagnant. And your option is going to expire going into a stagnant price, and you're not going to get the movement necessary to get it into or at the money, most likely. I'm going to turn this back over to Bob, who's going to give us an optimal example now.
I am Bob, and I'm going to give you an optimal example now. So conversely, here are some optimal conditions when a trader may consider an out-of-the-money binary option trade. So let's say a trader has a strong directional bias with expectations of stable or rising volatility going into busy market conditions. So you have an idea based on your method, your strategy, you think the market's going to go in a certain direction, and you think that volatility is either going to stay the same or rise, all right? And you may know of a busy condition coming up. For example, you know of a Fed meeting being released, or of beige book being released, or something like that, where you know market conditions are going to remain busy and they're not going to go stagnant. So let's review a path trading setup that would be suitable for trading an out-of-the-money binary option. This is a particular setup that we would look at in the way that we trade the market. So US 500 closes beyond a path trading significant level into a clear path move from a horizontal channel. So you can see highlighted on the chart here is something we would call a significant level. That's something that we teach. Excuse me. We've got another one down here, and this particular candle right here showing it closing above. We've got three significant levels on this chart, and we get a close above, and there's a horizontal channel beneath it that we seem to be breaking out of. The target is based on the horizontal, target based on the horizontal channel breakout is 2006, which you can see marked right around here. Binary option trade not entered yet due to poor reward to risk. It's not skewed in our direction, which is something we like for this particular kind of a trade. We looked to enter a 2003 binary option on the pullback towards that significant level. So again, here's the significant level, here's the target, which is another significant level. It's horizontal channel target. And you get a close above here, we get a rally, the risk reward was off on this rally, but now on the pullback here, we potentially have a trade we're looking for as time has gone a little bit lower. So a long binary position was entered at a price of 43.25. You can see it up here. Okay, it's highlighted in yellow. Red is not the one we're looking at. That's just something on the ladder that ticked. It's the one highlighted in yellow. So we enter it at 43.25. The target of 2006 was reached, and we took profits on the 2003 binary option when it was trading at 81.75. So notice again, 2003 is the option we took. All right, we entered it right around 2002 or so. As it went up, even though at expiration that thing was going to be worth $100, we took profits when it reached our target. We always do that. Okay, we could have waited till expiration, but as you can see, there's still a bit of time to go. There's over 15 minutes here, and 81.75 is where the price was when it reached our target, so we exit. We always exit when we've reached our target on a particular price pattern. So in this webinar, we covered various aspects of trading out of the money Nadex binary option. We examined how some of the Greeks affect the binary options, And we also looked at the optimal and non-optimal market conditions, which can help a trader determine when to trade out of the money binary options. Now, as I mentioned earlier, you're probably going to need to review this information multiple times and then determine how this information can work to further help you successfully trade out of the money binary options with your trading strategies. It's important to note that there was a lot of information given in this particular webinar, and we go over it, I don't want to say quickly, but there's just so much where you may have had some traders speak in there that you didn't quite get. It's all in the graphs and it's all in the presentation. And then there's also stuff you can find on our website. So tune in next time. We'll be looking at trading binary options that are in the money. We will again look at the market conditions that are beneficial and detrimental to trading the binary options in the money. It'll be helpful for a trader to again review the Greeks, as I showed you where those are at on the archive section, and the various characteristics of them and how they apply to Nadex binary options. So again, we are Path Trading Partners. I'm happy to take any questions you guys have at this point. Visit us at pathtradingpartners.com. Sign up for free stuff. We don't send emails out unless we have something really important. I think we sent an email out about 2 or 3 months ago. We've got another one that might be coming out in another couple of weeks, maybe this week, maybe next week. We don't hit you up with emails like crazy because we're not crazy about doing that. Our job's to trade. If we have something to tell you, we will tell you. So sign up for the free stuff. Take a look at the courses that are offered in there for sale. Also, like us on Facebook. Follow us at @path_trading. And please, if you could, excuse me, check out our podcast, The Money Path. I'm pretty proud of that, and that's also available on our website along with all our blog articles. So if there's any questions, we're happy to stick around. I'll wait a couple minutes and watch the attendee list, see if there's any questions being typed in. If not, we'll talk to you guys next week. Again, just type them in the questions box. If I don't see any being typed in, then again, I highly recommend watching this 2 or 3 times. It'll be in the Nadex archives where the other things are as well. Question. Great presentation. Thanks for that, Yves. So is it fair to say that the last hour of trading is the most important time for the binary trader? Okay. It's hard to say no to that. It's really hard to say no to that, but it really depends on what type of binary option you've put on, whether it's out of the money, in the money, or at the money. In the example we gave you, we exited that with 15 minutes left. So that last hour wasn't necessarily the reason we were able to exit that. It obviously, Mike explained very well how Theta actually helps you and how your price goes closer and closer toward 100 when you're in the money. But when you're out of the money, it's pretty important in that last hour. When you're out of the money, you're losing money as it goes in. So it's very hard to say no to that, Mr. Joseph. But yeah, we exit our trades. That's one of the things that's an advantage about being at Nadex, is that you can actually exit. A lot of the non-regulated or unregulated binary options you have out there don't allow you to exit a trade. So that's why we like to pursue our binary goals here at Nadex. So I'm going to put a blanket yes to that. It is the most important time, but you don't necessarily have to like shut your screens off and wait for that last hour, because there's a lot of opportunity that happens prior to that last hour. So
also you get a lot of time decay, especially in the last 15 minutes to expiration. Depending on how far out of the money you are, your time decay really starts hurting the position. So that's where, you know, especially for what markets, because implied volatility can also affect it, but I'm really watching stuff, especially with 15 minutes to go. If things aren't moving and we're getting into, you know, the conditions are different from the reason I put them on, I'll really start paying attention to that, especially as it's farther out of the money in the last 15 minutes, because that you can really lose a lot of value rapidly in your Theta.
Yeah, I mean, the way you worded that question, Yevis is, I hope I'm saying your name right. I don't know if I am. The way you worded that question, where is it the most important time as opposed to the most beneficial time, or whether you're making money or losing money. I mean, if you're way in the money, if you've bought a 2010 on the S&P, for example, and the S&P is now at 2025, I mean, that last hour just isn't going to do that much. You're going to get the time decay, but a lot of it's going to have weeded out at that point already. So it is the most important time, but There's just all kinds of different conditions that go into that. Anyone else, guys? Happy to stick around for a few more minutes. Otherwise, we will bid you farewell. I'm getting a lot of thank yous. I appreciate that. We're great, but I don't like to read it on the webinar when you guys tell us how great we are, so I'm not going to read that. Oh, I just did. One more question. Hold on. We're getting one more question. Thanks for typing that in. I was just about to turn you guys off. Mr. Joseph is writing one more question. Is an experienced binary trader better equipped to master options trading? I'm going to turn that to Mike because Mike is really the options master here at Path Trading Partners. But I'm going to say that binary options and especially spreads, Nadex spreads, is a very good training ground for understanding some of the key things in options. But Mike, disagree with me if you disagree. I think it's a great training ground.
No, I think it's a great way to, because they're structured products, even especially spreads. Because in the pure options market, you're going to have to construct your own spreads. You have a lot more flexibility. Where with Nadex, they've already structured the products, they've structured the strike prices, they've structured everything for you. And binaries help you understand, I mean, if you can start grasping like the concepts of Theta and Vega and Delta, what we go over in both the binaries and the spreads presentations, and you can do it in sort of a more contained environment where you can understand in binaries. All right, intrinsically it goes from 0 to 100 the moment it passes that at the money price. And extrinsically, if it's all your value below at the money is extrinsic, so the theta will hurt that. Whereas if it's in the money and you want to join us next week and see how that helps you and how the things we covered today on out of the money can actually work for you when it's in the money, you start to see those concepts put together with these very well structured products. Then you can take that same knowledge into any option marketplace, whether it be stock options, future options, foreign exchange options, and start constructing your own more complex positions, and you'll understand sort of how they behave because of all the information you've learned, not only through the theoretical side of like the webinars, but then taking this theoretical knowledge, taking it into your trading account, and actually putting it to use and seeing how it can help or hurt you depending on where the underlying is relative to your strike price and what time expiration is going by and how much implied volatility is changing. You can start seeing that the light will go on, and then you can take that into sort of an unstructured environment where whatever options you want to trade.
One of my favorite things about these is if you can understand why your extrinsic value is negative when you're trading an at the money and why it's not necessarily, why it's positive with a spread. That really, all of a sudden, it turns on the light bulb for a lot of people. If you understand that part of it, when you understand the intrinsic value on a binary is immediately 100 the minute it crosses at the money, whereas that's not the case with a spread. And if you can understand that little nuance right there, you've come a long way toward understanding some of the core options concepts. So yeah, I really do believe, especially because Nadex is regulated, that Nadex is the place to kind of get that training, kind of get that sort of sorted out for you before you move on to regular options trading. All right, while we were rambling about that, nobody else wrote anything else. Any other questions, guys? Again, sign up for our free stuff. Check out the courses that are for sale, but we're happy to have you just sign up for the free stuff. We'll reach out to you guys very rarely. And listen to our podcast, The Money Path, where we cover a lot of different things outside of the world of binaries. And you can kind of get to know who we are.
And Bob, you're not the one that rambles, that's me.
Thanks for the rambling, Mike. All right, guys.
That wasn't a ramble, that was succinct.
Cheers, everybody. Thanks for being here. We will speak to you guys next week.
Talk to you guys later. Thanks for being here.